Next up, let's look into one of the most common dilemmas on getting better returns. Should one buy an insurance savings plan or top up their CPF accounts? What are some areas where one can better understand before making that decision? What are some of the areas that you can actually think about on leaving a legacy through either option? We will be inviting Mr. Christopher Tan, founder and CEO of Providend, to share with us his insights on this challenge. Mr. Christopher Tan has more than 2 decades worth of experience in wealth management and financial planning industry. He is often featured in broadcast and print media for his expert opinion on financial matters. He is an internationally sought-after speaker, counting the CFA Institute Annual Conference and Money Sense among his speaking engagements. So feel free to type your question in the chat function beside the live video, and due to time constraint, the speaker may either take 1 to 2 questions or not take any questions at all. So let's invite Mr. Christopher Tan, please.
Hello everyone, a very good afternoon to each one of you, and thank you so much for still staying on. I know it's been a long day, and I understand also yesterday you had a full day of session, so I hope our brains are not too fried to do this last session before the panel. So I've been asked to speak on the topic on insurance savings versus topping up your CPF. What are your options? And because I've got so much to cover, I really just want to get on with it. And I hope to finish early so that I can at least take 1 or 2 questions. But just before I go into the proper, just a quick disclaimer to say that whatever I share here is just a house view of Providend, and because all our situations are different, and before you act on any of these suggestions, please speak to your financial advisor. So what are we going to talk about this afternoon in this final session before the panel? Well, I'm going to quickly talk about CPF as an accumulation tool, and then comparing it with endowment insurance as an accumulation tool. What does it all mean to us before I conclude? So let me start first by talking about CPF as an accumulation tool. Now, to really understand CPF as an accumulation tool, we first must understand the interest rate structure of CPF. And it might interest you to know that the CPF interest rate structure has changed since January of 2008. Now, so before we try and understand what it is right now, let me quickly take us through what it is or what it was before January of 2008. So before January of 2008, you can see on screen that our CPF OA is pegged to the 3-month average of the major local banks' interest based on an 80% fixed deposit and 20% savings rate ratio. Now, what do I mean? I'm going to show you an example. Yeah. Now, it's not possible for me to point you to the table, unfortunately, so I'll try and go a bit slower so you can follow me. So if you look at the 12-month FD rate, you see the 3 local banks, DBS, OCBC, UOB, and then you see all the interest rates over there from 30th November 06 to 07. Now, please just take note that this is the fictitious rate, it's not real, okay? So if you see DBS, it's 1.4% right through all the way until January 07. OCBC is 0.25 and UOB is 0.7. Now, you realize it's fictitious because it cannot be so far apart, right? Well, yes, well, normally they are quite the same, but just to show the difference, look at it, DBS is 1.4, OCBC 0.25, and UOB 0.7. And if you look over the next 3 columns, you see savings rate for DBS, OCBC, and UOB, and they are all at about 0.5. Now, so what it means is this. If you just look at the row for 30th November 06, well, for the 12-month FD rate, if you take 1.4 plus 0.25 plus 0.7, and you divide by 3, you get the average of the 3 local banks for the FD rate, but you take a 80% on it. That's what it means by an 80-20 ratio. You do the same for the rest of the months, and then now we go to the savings rate. So if you add DBS for 30th November 06, the row, 0.5 plus 0.5 plus 0.5 divided by 3 is 0.5, but you multiply a 20%. So if you add the FD 80% number and the savings rate, the 20% number, you get an average, if you look at the last column, 0.6367, and in fact, for every month after that is 0.6367. That's what it means by the 3-month average of the major local bank interest rate based on the 80-20 ratio. So that was what the OA was pegged to before January of 2008. And what that means is this, okay? What that means is that if the OA rate, the 3-month average rate, goes below 2.5, it's okay because across all CPF accounts, there is a floor rate of 2.5%. What that means is that even if you get lower than 2.5, your OA will still be 2.5. How about your CPF SMRA, which stands for Special Medisave Retirement Account? It is OA plus 1.5%. Okay, and it is also pegged, it also has a floor rate of 2.5%. So if you look at the table with me, ordinary account. Now, well, the interest rate, 3-month average of the major local banks' interest rate, and if the computed interest rate, as we have seen earlier, is about 0.64, what that means is that your OA rate, the actual rate will be 2.5 because that is the floor rate. But what this tells us is that there is a possibility that if the 3-month average of the local bank's interest rate is higher than 2.5, you can get actually higher than 2.5 interest. Now, for the SMRA, Special Medisave Retirement Account, it is OA plus 1.5, as I've said. So it should be 2.14 because 0.64 plus 1.5 is 2.14. But because there is a floor rate for OA 2.5, so you get a 4% interest rate for SMRA guaranteed. Now, this was before 1st January 08. Now, let's take a look at what happens after, or rather what happened after 1st Jan of 08. So after 1st January of 08, the OA, whatever I've explained just now about the 3-month average local bank interest rates is still very much the same. No change to that. But what has changed is how we get the CPF Special Medisave Retirement Account interest rate. It is no longer OA plus 1.5. It is now pegged to the 12-month average yield of the Singapore government bond, okay, the 10-year bond plus 1%. So if you follow me, the table, take a look at the table. So OA for, say, 2020, the 3-month average of the major local bank interest rate, let's say, okay, it's 0.64. Okay, the actual is 2.5 for OA, right? That's what we said. But take a look at the SA, MA, and RA. It is now no longer OA plus 1.5. It is pegged to the 12-month average yield plus 1. So let's just say for SA and MA, they calculate the rate of Feb 19 to Jan 20. And let's say the 10-year bond is 1.91. Then you plus 1%, you should be getting 2.91 and not the 4%. For RA, the calculation is slightly different, just the month is different. So let's say the 10-year bond rate is, well, you can see from the table, 2.05 plus 1%, you would only get 3.05 and not 4%. So that should be the case, right? Because that's after January of 08. Now, I know many of you watching this will be now confused because all the while you have been told that SMRA, you get a guarantee of 4%. But now I'm telling you that after January of 08, it is no longer the case. It is pegged to the 12-month yield of the Singapore government securities or the Singapore government bond plus 1%. So which one is right? Is it the 4% guaranteed that is right, or whatever I'm telling you just minutes ago, are they right? Both are right. Now, what do I mean? You'd probably be shouting and saying, Chris, can you clarify? What do you mean? Well, you see, when the government rolled out this new interest rate structure, they also gave us 2 goodie bags. I call it like goodie bags, right? The first goodie bag is this. Bag 1. Take a look. Regardless of the performance of the 10-year SGS, the SMRA interest is guaranteed at 4%. So what the government is saying is this. Yes, after Jan 08, yes, it is true that it is pegged to the 10-year SGS plus 1%, but I'll guarantee you on a yearly basis that as long as it is below 4, I will still give you 4. More than 4%, you get more than 4%, but less than 4%, you still get at least 4%. Now, just take note of this. This is an important point. This goodie bag 1 is regularly reviewed, okay, once a year usually. Yeah, so now it's coming to the end of the year already. Watch out from the news media, from what CPF board will be announcing whether next year it is still going to be like that. So far, it has been like that since January of 08. Now, that's the second goodie bag. And the second goodie bag is this. You can read off screen. For a combined balances of 60,000 subject to a maximum of 20,000 from your ordinary account, you get 1% more. I'm going to unpack this in a while for us to understand. but just take note that this is a permanent feature, meaning to say, as long as CPF board, they don't announce it, we are going to get this for as long as it lasts. So what do I mean what do I mean by a combined balances of 60,000 subject to a maximum of 20,000 from OA, you get 1% more? Okay, so let me show us a few examples. Example number 1, let's say you are before age 55 and you have got 60K in OA, 80K in SA. So the first 20,000, you are going to get 2.5 plus 1% more. So you get 3.5%. For the remaining of the 40,000, you are going to get 2.5%. Now, the rule says for a combined balances of 60K, right? Subject to a max of 20K from OA. So you have used up 20K from OA. You are entitled another 40K from your SA. So your 40K, I'm going to break it. 80K, the first 40K, you're going to get 10-year SGS plus 1%, plus 1 more percent, as you can see on screen. But because your 10-year SGS is guaranteed at 4%, as I've said, that's Goody Bag 1, you're going to get 5% guaranteed. And for the remaining of the 40,000, no more extra 1%, 10-year SGS plus 1, you're going to get 4%, okay, because there's a guarantee of 4%. Now, one more thing to take note. The extra 1%, the absolute dollar that you are getting from that 1% in your OA, it is going to be transferred into your SA. It will not stay in your OA because the primary purpose of CPF is really for retirement. And OA, as you know, you can use for so many things. You can buy a house with it. You can lend it to your children for their education, so on and so forth. And therefore, the extra 1% that you are getting from your OA is going to be credited into your SA. Okay, so I hope this is clear. But let's quickly go to example 2. Now, OA 10K, SA 30K, MA 30K. So the rule says first 20K in OA, you get 1% more, but you only got 10K. So the whole 10K, you are going to get 2.5% plus an additional 1%. So you get 3.5%. Now, you still have 50,000 more that you are entitled the extra 1%. Let's go to SA now. Your SA has got 30K. So the whole SA, 30K, you are going to get 10-year SGS plus 1%, okay, and you're going to get that guaranteed 5%. Now, you have used up 40K, so you're entitled another 20K for the extra 1%, and your MA has got 30,000. So your first 20K in your MA, you're going to get that 5%, the extra, leaving just 10K in your MA, getting the original 4%. So you get 4% and 5%. If you look at it, first 60K, you get extra 1%. The rest, you're getting the normal, either 2.5 or your 4%. Again, one more thing to take note. For your OA, extra 1% is credited into your SA, but for your MediSave, with that extra 1%, it will remain in MA because, well, in retirement, we are still tapping on into our MA for either paying medical expenses or insurance premiums for approved insurances. So just take note of this. Now, there is actually a third goodie bag that was given to all of us in 2016, right? And it is really on the RA. So I'm going to give you the third example for a person that's age 55 and above. So let's say your RA has got a 100K retirement account. The first 30K, you're going to get 10-year SGS plus 1. That's the original interest rate plus 1%, or rather plus 2%. So you're going to get 6%. Yeah, because your 10-year SGS is guaranteed at 4%. Right? Now, how about your next 30K? For your next 30K, you're going to get 10-year SGS plus 1 plus 1%. So you're going to get 5%. And for the remaining of your 40K in your SA, or rather, your RA, you're going to get 10-year SGS plus 1%, and you get 4%. So in your RA, now you get 4%, 5%, and 6%. So I hope that is clear. This is what I call the third goodie bag. Now, so if you think about it, it is really not bad, right? Because to get 4%, 5%, 6% guaranteed, no volatility you have to go through, is actually pretty good. And that's why I say that CPF, if you look at it like an investment instrument, it is the best investment instrument you can find for you to accumulate towards your retirement. The returns are high relative to its risk. It's almost risk-free. The returns are guaranteed by the Singapore government. The capital is guaranteed. You are not going to lose your capital. Well, and it is only possible because the Singapore government is behind this. but you have to expect, firstly, no liquidity. I always joke that putting money into CPF is like joining secret society. Very easy to put in, but impossible to get out until at least 55 years old, or almost impossible to take out until 55 years old. So no liquidity, you have to expect that, and you have to accept some policy risk, because sometimes government may change their rules, although it hasn't happened that often, but we have to accept some form of policy risk. And the third point here is that there is a limit. As much as you like it, as much as you like this so-called instrument, well, there is a limit that you can contribute and top up. Now again, what do I mean by that? Well, there are really three ways to top up your CPF account. Firstly is by this thing called RSTU, Retirement Sum Top-Up Scheme. Now, so before age 55, because RSTU works for you before and after age 55, so before age 55, you can top up your SA, because you don't have RA, you can top up your SA up to the full retirement sum, and today that amount is 186K. Now, how can you top up? You can either transfer money from your OA to your SA before age 55, or you can top up your SA using cash, and you can enjoy a tax relief of up to 14K. Now, how do I get to that 14K? 7,000 on yourself, 7,000 if you top up your spouse, sibling, parents, grandparents, or parents and grandparents-in-law. But just do take note that if you are topping up your spouse and siblings account, and if you want to enjoy that relief, your spouse and your siblings' annual income must not be more than 4,000. It's as good as saying that they are not working. Yeah. Now, of course, as a second way, or rather, the RSTU also apply to you when you are above age 55. And so now you top up to your RA. You cannot top up to your SA. You can only top up to your RA up to a higher amount called the ERS, Enhanced Retirement Sum. And the amount currently is 279,000. Yeah? Each year, this FRS and ERS goes up by about 3%. Now, the second way you can put in more money into your CPF, if you like it, is by CPF Voluntary Contribution Scheme. And the thing about this is that when you voluntarily contribute, you cannot choose which account you want to put. It will be distributed over the three accounts, OA, SA, MA, according to the allocation rate based on your age band. And you can only contribute up to a maximum of $37,740, and that will include your normal working contribution as well. Now, if you are using cash to do this voluntary contribution, the tax relief only applies to a self-employed. So if you are an employee, unfortunately, if you are using this way of putting more money into CPF, you are not going to enjoy that tax relief. Now, the third way to put in more money, and I'm quite sure a lot of us already know, and that is the voluntary housing refund. And what that means is that by using so-called this channel, it allows you to refund your CPF monies that you have used to fund your house. You can refund any amount at any point in time up to the full principal amount that you have withdrawn for the purchase of your property, for your monthly mortgage, plus accrued interest. The interest you didn't get from your OA, the 2.5%, when you took out this money to pay for your property. And this money goes back into your RA, and you are getting 2.5%. So these are the three ways that you can actually put more money into CPF if you like it as an accumulation tool. So I'm done with the CPF portion, and you realize that it's actually quite good. The returns, quote unquote, or interest is actually quite high and very low risk. Three ways to top up. How does it compare to buying an endowment insurance as using it as an accumulation tool? So what is an endowment insurance? Now, it's not rocket science. Endowment insurance has been around for a long, long time. But, well, basically, every dollar that you put into buying this endowment plan, and it could be a 10, 15, 20 years endowment plan, it's a saving plan, well, it's split between insurance, and a portion of it will go to investment into the participating fund, whereby when you buy the insurance, if you look at the numbers running, you will see that now, since July this year, the projection rate has gone down to about 3% to 4.25%. It doesn't matter which company you buy from, everybody has to project with the same number. Right? So every dollar that you put into an endowment insurance, a portion goes to insurance. That's why you get some sum assured, some protection, and a proportion goes into the PAR fund. Now, PAR policies, which includes your whole life plans, your retirement income plans, they are the most sold policies in Singapore. It accounts for about 46% of the insurer's new business. And par fund, the monies in par fund, the insurer usually invests mostly in fixed income because it's more stable. Now, the projection, whatever is placed here, it doesn't really affect the actual returns of previous policies or future policies. It doesn't really affect. So you don't have to worry like I've got to rush and buy each time the insurer adjusts its fund. Now, so let's take a look at the return. Again, I know that there are a lot of numbers here. Okay, so follow me closely. So this is for single premium. That means to say you can buy endowment insurance by putting in a lump sum. And let's say this is for a 35 years old, a male non-smoker buying a 30,000 sum assured endowment plan. And you can see on the leftmost column is 15 years, 20 years, 25 years, 30 years endowment. And so the total premium paid is 30,000 because it's one lump sum, right? Look at the maturity value based on a 3% to 4.25% projection. Okay, now the maturity values may not tell a lot. If you look at the actual return that you are getting, annualized return that you are getting, if you take a look at 3% for the 15 years endowment, for this particular policy by a local insurer, you are getting 1.75% per year. 20 years, 2.37, as you go down, 2.45, 2.49. If you look at the 4.25% projection column, the last column, you see it runs from 2.9 all the way to 3.54% per year. Now, one thing to take note is sometimes people think that, oh, the insurance company projects 3%, 4.25 means I'm getting actually 4.25. No, you are not, because remember, only a portion of your premium is going into the par plan. A portion has to be invested, or rather has to be used to buy the 30,000 in this case, sum assured that you need. So the actual return, even if the insurance company is able to get 4.25% from the par fund, you will be getting lower than the 4.25. Let's take a look at another insurer, or rather another type of endowment plan. This regular premium means you put in every month or every year. So I'm showing you 15, 20, 25 years because there's no 30-year plan for a 35 years old. And this is again by a local insurer. Take a look at the right most column. 3% is only 0.36 per year for a 15-year endowment, going down all the way to 0.53%. And if you look at the last column for a 4.25 projection, it is 1.75% all the way down to 2.18. Not very exciting, really. Let me show you a foreign insurer. It looks better. If you look at the 3% projection, again, this is for regular premium, you are getting 1.59% per year for a 15-year endowment, all the way to 25 years endowment, 2.21. And then if, well, the insurer managed to deliver 4.25% from the par fund, is 2.6% all the way to 3.23%. Now, so what does it all mean to you, really? Let me put it all together. If you compare ordinary account, special account, endowment insurance, well, the investment instrument so-called under OA and SA, it's really the Singapore government bond, but this is the special one, SSGS, Special Singapore Government Securities. You cannot find it in the bond exchange. This is a special, sometimes I say Kelong arrangement between CPF board and our government, okay, to allow CPF board to use our CPF money to buy this SSGS. It's AAA rated, very safe, guaranteed by the government. For endowment insurance, the underlying what you are investing is the par fund. The returns for per annum, well, for OA, you are getting between 2.5 to 3.5. For SA, you're getting 4 to 5. For endowment insurance, well, it ranges from 0.45 to 3.5. It's not guaranteed. A portion may be guaranteed, but the overall return is not guaranteed. In terms of liquidity, they're all not liquid. Policy risk, of course, OA, SA, there's some policy risk, but for insurance, no. At maturity, well, for OA and SA, after setting aside the basic retirement sum, which is today 93,000, as a member, you can withdraw the rest, okay? And from age 65, whatever you put into your RA, it will be streamed out from your CPF life. For endowment insurance, when it matures, it just comes out as a lump sum. Now, what is it suitable for? Well, suffice it to say, if you are putting money into OA and SA and you're using it as an accumulation instrument to save towards something, that something must be a need after age 55, because you know before 55 years old, you cannot take out money from your CPF. If you need to save towards something that you need before age 55, then endowment insurance might be more suitable. So let me conclude. Firstly, in terms of risk-adjusted return, CPF is the clear winner. Yeah? You cannot get this kind of return guaranteed. If you need money before age 55, endowment is definitely more suitable because you don't expect to take out money from your CPF before age 55. But you know, if you really want to use endowment as the instrument to save towards your goal, because the returns are not high, you really need to save a lot. Your premium needs to be very high. It's not a very efficient way to save towards your goal. I suggest using cash. If you understand investment, if you have got a long runway, 10 years, 15 years or more, consider using investments. And before you run and go and use your CPF OA for investing, let me suggest this. If you have got spare cash, use your cash first. Use your CPF later because your OA gives you at least 2.5%. Your cash is getting lesser. So use your cash first before rushing into using your OA for investment. So I'm done with my presentation. I think I still got a few more minutes, which is great. I can answer some questions. Okay, so there are so many, okay, so I'll just read from the top, okay? So the first question, what would be your recommended option? Top up CPF, can deduct taxes. How about endowment plan? What's the difference, benefits of both? I think I've covered quite a bit of that, but I'll just say this. If you are going to top up CPF, it must not just be for the purpose of saving tax. Yeah, because when you put your money, when you top up your money, whether through the various 3 schemes that I've mentioned, you lose liquidity. You don't want to top up to a point whereby if there is an emergency, you cannot take out the money from CPF. Yeah? The primary motivation must not be from tax because, well, lucky or not, the tax deduction is just 7,000. Yeah? For endowment plan, I personally, it's a personal opinion, I don't like it at all. I don't buy any one of it because I don't find the returns to be exciting. And then I don't have liquidity either, right? I mean, if I want to surrender, yes, I can, but I'll probably lose money. So is it possible for us to top up our CPF after we reach 55? Answer is no. Okay, after 55, you can only top up your retirement account. Okay, now, it says here minimum sum. Minimum sum is an old name. Today, if you are before 55 for special account, you can top up to your full retirement sum. The amount is 186K. After 55, you can top up your R8. You can only top up your R8 up to ERS, Enhanced Retirement Sum, and that amount is 279,000. Next question, is it possible for us to top up our special account after we reach 55 years? Okay, again, it's the same question. No, you can't. You can only top up to your RA after 55. Are these par funds projection of 3% and 4.25 even realistic given the current low yield, fixed income environment, and expected to continue for quite some time? It's a very good question you asked, Jamie. It's difficult for sure. Yeah, and that's why over the years, when I started my career since 20 years ago, these projections have been coming down. I'm not saying it's not possible, but I'm just saying that, well, increasingly it's going to be quite challenging for the insurance company to deliver that kind of returns, and yet they are only allowed mainly to invest into fixed income because, well, of some rules. For young couples who have paid HDB flat from CPF, can they return money into CPF? If needed in future for housing, can withdraw again from CPF? Answer is yes. Okay, if you have paid from your CPF, you can actually do a housing refund at any point in time. Okay, and if you need it for future housing, yes, you can withdraw it again for your housing needs in the future. But again, a word of advice, please be very careful because you don't top up, you don't put it back until you have no liquidity, you have no emergency fund, no cash at all. And then if you need it on a rainy day, well, that might be quite challenging. Okay, am I able to top up my OA if I am receiving CPF Life? Well, the only way you can do that is by a housing refund. So if you are above 65 and you are receiving CPF Life and you have paid your mortgage using your CPF, you can always do a housing refund and put back into your OA. And that's a good idea if you have cash in the bank. Okay, I think that's about it for the questions. Okay, because there are some questions on interest. Because of the limitation of time, it's going to be very difficult for me to explain. Yeah, but I hope you have enjoyed this session and you have found this session to be beneficial. Remember, before you take action, do speak to your financial advisor. Thank you very much for watching this.